You know that feeling? It's 11:30 p.m. on a Tuesday. You're already in bed, the lights are out, and suddenly your brain decides to replay that one awkward thing you said 5 years ago. Yeah, that's bad. But there's a specific financial version of that. That is arguably worse. It's that split-second panic when you open your banking app and the little loading spinner just keeps spinning. Or maybe you see a news headline about a liquidity crisis at a major bank, and for a brief, terrifying moment, you picture your mortgage payment and your grocery budget just evaporating into the digital ether. It feels like the floor is dropping out, right? We've all been conditioned to trust the system. We swipe the card, the machine beeps, the money is there. It's magic. But deep down, in that lizard part of your brain, you know it's not really magic. It's just a promise. And sometimes, promises get broken. I've been obsessing over this lately, like really keeping me up at night, kind of obsessing. My name is B.O.B., and I spend way too much time thinking about money, financial history, and why some people seem to sleep like babies even when the economy is on fire, while the rest of us are stress-eating pizza and refreshing our balance every 5 minutes. It's not just about how much money you have. It's about where you put it, and more importantly, how easily you can actually touch it when things go sideways. Because here's the thing nobody wants to admit. We might be living through a history lesson in real time. The dots are connecting in a way that feels uncomfortably familiar to anyone who has cracked open a history book from the 1930s. And if you know where to look, there's a strategy from that era, a specific, almost forgotten way of handling cash that saved the savvy while wiping out everyone else. It's not about gold, it's not about crypto, and it's definitely not about stuffing 20s under your mattress. It's something smarter, something that turns a systemic failure into just another Tuesday. So let's dive in, because understanding this could be the difference between panic and peace of mind. Okay, so to understand where we're going, we have to look at where we've been. And honestly, you can't talk about bank failures without talking about the granddaddy of them all, 1929. Now, we all know the stock market crashed. Black Tuesday, ticker tape machines choking on paper, guys in suits jumping out of windows, although, fun fact, that was mostly exaggerated, but the terror was very real. But what people forget is what happened after the crash. The stock market was just the spark. The forest fire was the banking collapse. See, back then, banks operated a little differently than they do now, but the core DNA was the same. They take your money, pay you a tiny bit of interest, and then lend it out to someone else for a big bit of interest. It's called fractional reserve banking, and it works great as long as everyone doesn't ask for their money back at the same time. It's a game of musical chairs, and there are never, ever enough chairs. When a market crashed, people got scared. Naturally, they wanted their cash. They wanted to hold it in their hands because they didn't trust the numbers on a ledger anymore. So they ran to the banks. But the banks didn't have the cash. They had lent it to people buying cars, buying houses, buying stock margins. So the banks had to close their doors, literally lock the gates. Imagine walking up to your bank, seeing a line wrapped around the block, shivering in the cold, hoping to get your paycheck out so you could buy formula for the baby, and then seeing the manager step out, put a piece of cardboard in the window, and just walk away. That was the reality for thousands of banks. Thousands. Between 1930 and 1933, roughly 9,000 banks failed in the U.S. alone. 9,000. If you had $100 in there, you had $0. Just like that. Poof. But here's the weird part, and this is the first piece of the puzzle I want you to really lock into your brain. While the average person was losing everything, there was a specific group of people who didn't just survive. They actually bought up the wreckage for pennies on the dollar. They were the ones with cash when cash was king. But they didn't keep that cash in the banks that were failing, obviously. So where was it? This brings us to the first major insight of this 1929 strategy, and it's something that feels totally alien to us today. We live in the age of digital abstraction. Your wealth is a number on a screen. It's entries in a database. It's electrons. And in a crisis, electrons are very fragile. If the power goes out or the internet gets throttled or the banking system freezes to prevent a run, something called a bank holiday, you can't eat your database entry. You can't buy gasoline with your PayPal balance if the system is down. The people who came out on top in the Great Depression understood a fundamental rule. Possession is 9/10 of the law, but possession is 100% of liquidity. You have to separate your spending money from your investment money. We tend to lump it all together. We have our checking account, our savings account, maybe an investment account. It's all linked. It's all digital. And that is the single point of failure. The 1929 strategy starts with a concept called velocity of cash. When the system is working, velocity is high. Money moves fast. I pay you, you pay the landlord pays the plumber. It's a flow. But when a failure hits, velocity hits zero. The flow stops. The stream dries up. If you're in the stream, you dry up with it. You need to be on the bank, holding a bucket of water. So, the first step is physical decentralization. And no, I don't mean buying a shovel and burying mason jars in the woods. Although, honestly, that's better than leaving it all in a vulnerable institution. But there is a smarter, more sophisticated way to do this that doesn't make you look like a doomsday prepper. Think about the structure of a bank. It's a vault. Why is a vault secure? It's thick, it's reinforced, it's fireproof, and it has a complex locking mechanism. It's designed to protect the bank's assets, not yours. But the concept of the vault is sound. You need a personal vault, not necessarily a literal safe in your house, though we will get to that, but a metaphorical vault for your liquidity. Here is where the strategy gets interesting, and it's a bit of a counterintuitive twist. In 1929, the big city banks were the first to fail. They were over-leveraged, connected to the stock market gambling houses, and too big to manage. But the small, local institutions, the community banks, the credit unions, they actually fared significantly better. Why? Because they knew their customers. They didn't have billions in toxic derivatives floating around in the ether. If you walked into a local bank in 1930 and the manager knew your dad, knew you ran an honest hardware store, they were much more likely to work with you, or to have kept enough reserves on hand because they weren't playing the high-stakes Wall Street game. So, the first part of the where to store answer isn't just cash under the mattress. It's strategic relationship banking. You need to diversify your banking relationships, just like you diversify your stock portfolio. If you have all your money at Chase, or Wells Fargo, or Bank of America, you're taking on massive concentration risk. If that specific ledger gets frozen, you're done. But if you split your funds between a traditional megabank for the convenience of apps and ATMs and a local, federally insured credit union, you've built a redundancy. Credit unions are not for profits. They're owned by the members. Their incentive structure is different. In a systemic shock, they tend to be more conservative. It's not a guarantee. Nothing is, but it tilts the odds in your favor. It's like having a backup generator. You hope you never need it, but when the grid goes dark, you're the only house on the block with the lights on. But let's be real. Banks, even credit unions, are still part of the system. They are subject to the same regulations, the same government intervention, and the same digital fragility. If the government declares a bank holiday and shuts everything down for a week, as they did in 1933, your debit card isn't working at the credit union either. This leads us to the core of the 1929 strategy, the part that feels radical, but is actually just basic financial hygiene from a bygone era. I'm talking about the private reserve. Look, I know what you're thinking. Cash. B.O.B. It's 2024. Cash is dirty, it's clunky, it earns zero interest. You're right. It does earn zero interest. And honestly, that's the price you pay for insurance. Think about car insurance. You pay hundreds of dollars a year for it. You hope you never use it. If you don't crash, you don't get that money back. It's gone. It's a negative return. But you pay it because the alternative, wrecking your car and having no way to fix it, is catastrophic. Holding physical cash is the same thing. It is an insurance policy against digital failure. The interest you lose by holding $1,000 in cash is the premium you pay for the guarantee that you can buy food, water, or gas during a banking outage. Now, how much? This is where people get crazy. Some people say 6 months of expenses. That's great if you're rich. For most people, that's a lot of cash to have lying around. A realistic target is something I call the storm window fund. It's not your full emergency fund, which should probably be in a high-yield savings account online. This is separate. This is, say, 1 to 2 weeks of essential spending. Groceries, gas, medicine. If the banks go down for 10 days, which happened in 1933 and has happened in various countries since, you need to be able to live your life without swiping a plastic card. So, where do you put this private reserve? Obviously, a safe at home is the go-to. But not everyone has a safe, and honestly, sticking $5,000 in a safe from Walmart is risky. If you get robbed or there's a fire, that money is gone. This is the specific nuance of the 1929 strategy that nobody talks about. Back then, wealthy individuals didn't just keep cash. They kept cash equivalents that were durable and portable. I want you to think about something for a second. If you have $10,000 in $20 bills, that's a stack. It's thick, it's bulky, it's hard to hide. But what if you could store that value in something the size of a deck of cards? I'm not going to sit here and show gold coins. Gold is great, but it's a liquid in a real pinch. You can't walk into a 7-Eleven and buy a gallon of milk with a Krugerrand. The clerk looks at you like you have 3 heads. They don't know the spot price, they don't have a scale, they don't want the hassle. The 1929 strategy favors small denomination silver and specific, universally recognized cash equivalents. Silver dimes, quarters, halves. They have intrinsic value but are small enough to be spent. In a true hyperinflation or currency collapse scenario, think Weimar Germany or modern-day Venezuela, people stop trusting paper money instantly because they know the government will just print more of it tomorrow. But they always trust silver and gold. It's been money for 5,000 years. It's in our DNA. But even beyond metals, there is another layer to this. The strategy involves dead capital assets. Let me explain what I mean by dead capital. It's stuff that holds value but isn't liquid in the stock market sense. In the Great Depression, people who had hard assets, land, tools, equipment, jewelry could trade. Cash was hoarded, so nobody wanted to spend it. But if you had a tractor and your neighbor needed his field plowed, you could make a deal. You had utility. So, part of storing your cash isn't just storing paper. It's converting some of that excess cash you don't need right now into things that are money in disguise. Let me tell you a quick story about a guy I read about, a banker from the 1920s. He saw the writing on the wall before the crash. He didn't tell his clients to sell their stocks. Actually, he quietly sold his own. He took the proceeds, and he did 2 things. First, he bought a bunch of U.S. Treasury bonds. Not the digital kind, the physical paper certificates. Back then, bonds were beautiful pieces of paper with intricate engravings. They were bearer bonds, meaning whoever held them owned them. No registration, no trail. Second, he took a significant amount of cash and bought high-quality, brand-name mechanical watches. Sounds crazy, right? But think about it. In a depression, nobody buys a new watch. But watches break. People still need to tell time to catch the train to get to work. A high-quality watch is a store of value that is also functional. And crucially, it is highly portable. If you need to flee a city, which many people had to do in the 1930s due to dust bowls or economic collapse, you can't carry a safe. But you can wear 3 Rolexes on your arms, or in your case, 3 high-grade Hamiltons or Pateks. He buried the bonds in a waterproof canister in his garden. He kept the watches in a hollowed-out book on his shelf. When the banks closed, his net worth didn't skip a beat. In fact, when the market hit rock bottom in 1933, he used those bonds to buy real estate for pennies on the dollar. He became one of the wealthiest men in his state. This is the essence of the strategy: portability and recognizability. If you're storing cash in a bank, you're trusting the system. If you're storing cash under your mattress, you're trusting your neighbor not to rob you. But if you store your wealth in assets that travel with you, you are trusting yourself.